Hi everyone, my name is Fischer, also known as the New York City Broker. Today I'm going to share some tips with you discussing co-op financial requirements in New York City. Co-op financial requirements in New York City include a sizable down payment, a healthy debt-to-income ratio, and proof of post-closing liquidity, or money you have left after you have made the down payment and paid most of the closing costs. When you buy a condo, you are buying a piece of real estate that's your own. But when buying a co-op apartment, you are essentially becoming a shareholder in a business, and the other shareholders, represented by the co-op board, need to make sure that you will not become a financial burden on the cooperative. This is why the co-op financial requirements in New York City are so strict. There are three main co-op financial requirements you need to know about. Number one is the down payment. Number two is debt to income ratio. And number three is post-closing liquidity. When you are buying a co-op apartment in New York City, you will need a down payment of at least 20 to 25%, which is the usual benchmark, but it can be more. In more extreme cases, it can be 50% or higher for some higher end buildings, or based on the financials or structure of the building, they may require all cash. In very rare cases, you might find a co-op where you can buy an apartment with just a 10% down payment. A co-op that requires a large down payment can be potentially problematic for the buyer because it reduces the amount of cash you have left for closing costs and the post-closing liquidity requirement that most co-op boards have. It can also hurt the resale value since other prospective buyers will have to come up with that same minimum down payment. Still, since co-ops tend to be more affordable than condos and they make up the bulk of the apartment market, about 75%, many buyers are okay with the higher down payment requirements. Co-op debt-to-income ratio requirement. The debt-to-income ratio, or DTI ratio, indicates what percentage of your monthly income you will use to pay down the debt you have, including your mortgage, credit card payments, student loans, medical bills, etc. A higher DTI ratio means a higher financial risk. So co-ops in New York City often want buyers to have a low DTI ratio. 28% is the magic number, but it can vary depending on the building and the prospective buyer's full financial picture. The DTI ratio is calculated by adding how much money you pay toward your debt every month and dividing it with your gross monthly income before taxes. Let's say you have a gross monthly income of $15,000. You also have a student loan which requires you to pay $1,000 every month. If you get a mortgage with a monthly payment of $2,500 and the maintenance of the co-op is $1,500, the amount you will pay toward your debt every month will be $5,000. Your debt-to-income ratio will be, or the DTI ratio is, $5,000 divided by $15,000, which equals 33%. This might be a little too high for co-op boards, depending on their requirements. Co-op boards are not the only ones that care about a buyer's DTI ratio. The bank that gives the mortgage to the buyer for buying the co-op or any other property also calculates their DTI ratio to determine if they will be able to pay back the mortgage to the bank. If the DTI ratio is too high and the buyer is using a very large portion of their income to pay their debts, their chances of defaulting on their payment are higher. But a co-op's DTI ratio requirement is usually even stricter than a bank. There is another complication when it comes to the DTI ratio. Many co-op boards want you to have a stable income, such as a consistent monthly salary. It ensures that a set amount of money is coming into your bank account every month, and you can use it to pay for your mortgage and maintenance fee. So they might not look favorably on the applications of people with income that changes a lot from month to month, or especially year to year, like freelancer. But if you have a lot of cash and other liquid assets to your name, and your overall yearly income is consistently high over the past 2 to 3 years, then a co-op board will most likely overlook your unstable monthly income. Post-closing liquidity, as the name suggests, is the liquidity, usually cash, that you have left over after the closing when you have paid the full down payment and all the closing costs. It's another layer of financial safety for co-ops and ensures that even if you lose your regular income source, you should still be able to pay your mortgage and your monthly maintenance payment. Most co-ops require you to have enough liquidity to cover 1 to 2 years of mortgage and maintenance fees. But let's assume you have a monthly mortgage of $5,000 and a maintenance fee of $2,000. You will need to have at least $84,000 in liquid assets to meet the 1-year post-closing liquidity requirement and $168,000 for 2 years. This is calculated by adding your total financial obligation related to co-op, which is mortgage plus maintenance fee, and in this case it's $7,000, and then you multiply that amount by 12 because there's 12 months in a year, and that's how we get $84,000, or by 24, which is 2 years, and that equals $168,000. It's important to note that liquidity includes more than just cash. It includes bonds, stocks, funds, etc. Basically anything that can be quickly converted into cash. But most co-op boards might prefer cash-based liquidity. Thank you so much for joining me in this discussion regarding co-op financial requirements in New York City. If you have additional questions, please feel free to reach me at brett@thenewyorkcitybroker.com. Also, don't forget to like, share, and subscribe so that you, your friends, and your family members can get all the best real estate content. I'm Brett Fischer, the New York City Broker. Have a great day.